Good morning, traders. It is Thursday, the 10th of September, 2015. It's 8 a.m. Chicago time. As always, thanks for joining, taking a part of your day and spending it with me. I appreciate that. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. Fair amount of movement overnight following on the sell-off that we had yesterday. Some interesting things to look at as far as the sell-off. But the Nikkei closed down 2.8% after popping up 7.7% yesterday on Abe's comments. Yesterday afternoon, Hilsenrath, the Wall Street Journal reporter who follows the Fed, said the Fed comments show disagreement on liftoff in next week's meeting. I still hold to the belief that the Fed isn't going to raise rates for quite some time. I've mentioned that a lot throughout the year, since the beginning of the year. I just don't see that happening. And you see this across other central banks too. The Royal Bank of New Zealand, the Reserve Bank of New Zealand, cut rates last night by 25 basis points to 2.75%, and further easing seems likely. So I don't see us increasing interest rates and making the dollar more valuable as it already has appreciated quite a bit. Just now, about a half hour ago, initial claims came in at 275,000 in line, and continuing claims 2.26 million versus 2.25 million. And what's left for today? I want to get to the charts real quick. What's left for today is wholesale inventories expecting 0.3%, wholesale trade sales 0.1%. So we're looking for numbers a half hour in. Natural gas at 9:30, just an hour after the open. I don't have an estimate there. And then crude oil inventories expected to be at 10 o'clock Central, 11 Eastern, expecting 250,000 for crude oil inventories, 1 million barrels for distillate inventories, and 0 for gasoline inventories. As far as speakers, there was a lot overnight. ECB, Mersch, Kerr, BOE's monetary policy committee meeting, ECB's Prate, ECB's Mersch again, all spoke before the U.S. Open. And there's just a lot of volatility overnight. So let's switch gears and look at what we have for a technical picture here. I want to start by cautioning everyone and reminding everyone that it is rollover day for U.S. equity indices today. The treasuries have already rolled to December. Expiration Friday is next week. Next week is expiration week. It's a quad witching Friday, next Friday, not tomorrow. But the official rollover occurs today on the exchange. We move to trading December 2015, or the Z contract, this morning. I recognize there's some philosophical differences as far as when you should roll, and you should roll with when the volume rolls and all that stuff. I do not participate in any of that. In my opinion, it does not make a difference unless I'm swinging 1,500 lots in here. I can move to December today, and I don't really care that the volume in December is much lower than the volume in September, because ultimately the majority of the participants in the September contract have to roll to December if they want to hold their position through expiration next week. So it's 6 of one, half a dozen of the other. Rolling today, however, keeps things neat in that my trusty IQ feed data feed rolls with the exchange, and it just allows me to make it a nice neat rollover, in that all I have to do is come in this morning and do a full data download. I'm going to show you real quick. For those of you, I know a lot of you use IQ feed or DTNMA for historical data with IRT. The simplest way to do the rollover is to pull up a quote page, go to your futures, select the futures page, open it, and then all you'd have to do, where's my futures page? Oh, it's over here. open it. So these are all the futures contracts that I'm tracking. And then you just go to the gray area, you right click and you hit download data. And when you hit download data, it'll ask you, do you really want to do a full download of all of your data? And you say yes, and then that's going to bring in all of your back adjusted, equalized futures data ready to go. And so this is how I do it. The next step is, of course, to remove the holidays. You can see here that the Monday's gone. So you go to each product, you right click in blank space, you go to scrub, click on holidays, and then the system will go and remove the holiday data from the from your retained historical data, and it keeps your charts clean. So what you're looking at here is a rolled contract. So when I pull up a composite, you'll see that the high is only 21.17. It's 9.25 points lower than the high we actually put in, and that's because all of my data has been back adjusted as far back as the eye can see. All of my data has been back adjusted to match the December rollover. If your computer does not do that, or if your software package or data feed does not do that, you will likely end up with a much bigger gap. When you look at your overnight data, you're likely to end up with a big gap down here. When the roll happened, you'll end up with much different information than what you see here. This information here is correct. It has been adjusted and it correlates with the cash index. I hope that makes sense. I know I took quite a bit of time talking about that, but it's really important to understand that I am quoting December today. So if you want to trade September, that's fine. Just understand that the levels that I show here are going to be lower by 9.25 points. That's the adjustment factor. That's the premium adjustment factor between the December and September contract based on last night's settlement. So, you know, when you see 1912.50 down here, your number is going to be closer to 1921 something, 1921.75 or whatever that is. So that's something to factor in as you're looking at my charts here. Let's get down to business. So let's roll back. We're always going to look back at what we have done versus what we expected. Again, going back to Tuesday's trade. If you recall, we were looking the primary hypothesis pullback to around 41, and then a rally to 79 quarter. And that didn't happen on Tuesday. Those are, it would be 1970 even in the December contract. And that's where it gets tricky because I'm going back in history and I was quoting September and I'm looking at December. So you got to keep those straight. But it did not happen. It ended up pushing to 1968. You can see 59 right here, but it actually pushed to 1968. And then overnight it did push through the 1979 quarter in the September contract, which is the 1970 in the December, and we ended up with the idea that with a situation or the context that, hey, this is likely to be responsive. So yesterday's plan is a gap open which we got, and the expectation is for responsive selling back towards that 1979 quarter September contract, 1970 December contract. We ended up getting that 1970 test right here. And the primary hypothesis' next step was to say, if buyers exist, and I don't know if they exist, I don't. My job as a trader is not to sit here and predict the future. My job as a trader is to look at what information I have, what the probability is for the next move, and to bet on that move, period. So I'm not here to tell you what the market is going to do. I'm here to tell you what it could or is likely to do based on studies and based on the auction and how an auction proceeds. So We're looking for 1979 and a quarter, 1970 in the December contract. Um, as the primary target for Hypo 1. We got that pretty quick within about 10 minutes, 10, 15 minutes of the market opening. We got the primary target. Beautiful trade. And then the expectation is it would chop here because this is the MC point of control. It would chop here. And if buyers do exist, then buyers will likely step in at this moment. We're looking for a zipper to be put together in this zone. And then if buyers are going to come in, they're going to come in and push higher. That was not what we expected, though. We expected it to go down to 1979 quarter in the September contract, 1970 in December. And then the expectation is for it to continue lower to 1968.50, which was the high of the prior day. Again, in the December contract, that's 1959.50. Boy, it makes it really hard to talk about this stuff when I'm referencing two different prices. Excuse me. And so that's what we ended up having. We ended up continuing lower, so a nice little runner trade here. It ended up pushing lower, and then the expectation is deflection back. We had pretty decent range at this point, 20 points, 22 points or so. The expectation is for a deflection back, a tackle of the mid, and then if buyers are going to defend 1959.50 here in the December contract yesterday, then we're looking for it to make a higher low, exceed the mid right here, and then start working itself back up for another neutral day potential. That did not happen, though. It ended up pushing down into the 59.50, took it out by a tick, beautifully filling, and then it just could not get itself above the IB. That was a huge clue. Could not take back the initial balance low, and so after a while, it started to enter the prior day's range. Once it enters the prior day's range, we target the close, the gap close, we target value high, and then the big target becomes the point of control, 1939.75 in the December contract. That's what we were shooting for. Once it enters the prior day's value, the most likely test, and you can see here there's a small LVN that separates the upper distribution from Tuesday from the lower distribution. So as soon as it breaches here, that creates another opportunity. We're looking for, after it breaches, we're looking for a pullback to sell that pullback, and then target the 39.75 from 51. And that's a pretty decent opportunity. It gets you at least 11 points once you give up a few ticks for your entry. And so that's yesterday's trade was very much picture perfect until the end. This was a surprise to me. This continuation through the prior day's low. We do have a weak low left behind on Tuesday, but it was definitely much wider range than I expected. I did not look for this. I did not take any advantage of this. And then what we end up with is a multi-distribution day of telling us that yesterday the market could not agree on pricing and could not agree on value whatsoever. It just continued to seek prices lower and lower and lower. It closed well below 2 times the IB. It closed in the bottom quarter of the day, and it closed near the low. A nice little taper here, but still, this is a weak close. So what do we expect on a weak close? We expect continuation into the overnight session. We expect the market to continue exploring prices lower. Just because the clock said the session's over does not mean that the market should quit. And that's where that's where the open came in on the overnight session, and it continued lower to take out the low. So we have this small continuation move here, and then we chopped around until the Asian markets opened, and then the Asian markets had a pretty decent rally back up, and then the European markets had some decent news, and then from there it's just downhill. And then again, look at this profile from last night. The reason this profile is so choppy and so stringy like this is because it is representing the December contract when a lot of the volume was still in the September contract last night. So this is something to ignore somewhat, but it does show us that there was very little consensus on price yesterday as the market created this boxy profile and has walked itself right through all the intraday levels, intersession levels for the overnight session, telling us that a higher time frame is in control. This move here is an OTF move, and it does not look to be done. So why am I saying all this stuff? The point is not to give you the answer. The point is to show you how the answer is arrived at. Those who have been following for a while have seen how this process works, right? You make a call, great, it hits its targets. But why is the question. So there are a lot of people who make calls on Twitter and chat rooms and so on. But those calls, in my opinion, are useless unless you understand why the call was made, and to find your way or your path to duplicating that outcome, to duplicating that analysis, and hopefully duplicating the opportunity and taking advantage of it. And that's the point of this Trader Bite. So yesterday was a bearish engulfing day for those who love candlesticks. Just completely, this day completely engulfs the prior day. And guess where we ended up? We ended up right at that cutoff, right at that 1941, if you recall, the MCLVN. Remember, the MCVPOC is the one that was up here. That was our target from the prior session, from the Tuesday session that we got on the Wednesday overnight. And then what we've done is we've moved back through. We've tested above, and we could not get to the 81.75 December high, recent high. Got to 78 and a quarter, and then sellers dominated. And remember, I did mention yesterday that sellers really need to take back the 79 quarter, which is 60.75 now. They really need to take it back, and they really need to get this below the 1941 September MCLVN or 1931 December contract. The sellers need to keep prices below here and keep the auction in this lower distribution. So this morning, your target on the downside is going to be just that. It's going to be the MC HVN, the high volume node here. That's the next most accepted price, 1914.50 in a December contract. I'm looking for a small, in looking at what we're likely to have today, I'm looking for a small responsive buyer to come in. Some profit taking on the overnight session. The overnight session shows us that the overnight inventory is still long, but there's a catch here. Again, the December volume is not all here. In the September contract, this is a much higher delta. So even though price is lower currently, the delta is positive on the September contract. So you got to pay attention here. It shows that even though price is lower, the overnight inventory may still be positive. So if we do get a responsive buyer, which is the natural thing, if we do get a responsive buyer, I expect it to peter out here in the 1931 area, which was the 1941 MCLVN. And then I expect sellers to come in and start pushing this down to 1914 as hypo 1. If we do get responsive buyers and we pull back, chop around, and then push through, then you start to work on the next the big areas, which I'll highlight here. The HVN, yesterday's HVN, yesterday's LVN, the next LVN, the next HVN, or the point of control. Those become your targets above. But overall, the expectation is it pushes through. If hypo 2 pushes through this 1931 area, then the main target is going to be right here in the 1948.75. If it gets to 1948.75, Hypo 2 will be completed. But Hypo 1 is expected to be responsive buying back into the 1931 fight, chop around, rollover, and move back down to 1914. The action yesterday, even though we are in this boxy balance zone, in fact, I can start incorporating these two in here. The action in here says that sellers woke up yesterday and are in control again. So I'm looking for it to roll over and push into this 1914, 1913, 50 area. Okay. I know that's a lot to digest, but there you have it. That's the plan. That's what I'll be tweeting about. Again, quoting December. I'll catch you online, and hopefully this was useful to you. I'll catch you tomorrow. Take care.